There are a lot of value traps populating traditional benchmarks today, and the value traps there are going to be significant downside surprises.
Think of people whose jobs have now been displaced by this big step that business has taken to digitalization, who have no financial assets to begin with, so they didn't benefit from what has happened to asset prices.
You know, we've had so many hacks, terrorist attacks, the Colonial Pipeline incident. It would appear to me that we are extremely vulnerable to having an attack against the payment system of the financial markets.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance, Early Edition on this Thursday, the 30th of September. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Central bank chiefs tried to reassure the markets over inflation, voicing optimism that supply chain hitches will only lift inflation temporarily. While Senate Majority Leader Chuck Schumer says a deal has been reached to avoid a U.S. government shutdown this Friday, key risks to President Biden's economic agenda actually remain. And how artificial intelligence will change the world in the next 2 decades. We'll speak to the AI pioneer and China VC Kai-Fu Lee. Now, first, let's check in on the markets. And actually, it seems like it's a green day. If you look at the European stock 600 getting some 0.8%, we're seeing some similar gains for the DAX, the S&P futures. The point here is that there are concerns about inflation. We didn't have such great data out of China. Actually, some of the worst factory orders since last year, 2020. But overlying all of this uncertainty over inflation, whether it's temporary or not, is also a belief or actually optimism that at least some of the politics in the U.S. is easing up and we're not going to see that crunch time on October 1st. So let's quickly check on the European maps. There's a couple of stories that we also need to watch out for in terms of inflation and in terms of some of the margins that, for example, you're seeing on some of the retailers. So we got a nice little lift from H&M. Boohoo, though, on the way down in the retail space. The UK holding up 0.6%. We had 3 energy companies actually going bust because of higher energy prices. So this is probably the one story dominating the FTSE, and then the FTSE maybe in Italy getting some 0.5%. So the jump that we've seen in sovereign bond yields has highlighted concerns among investors about the persistence of inflation. But the Fed Chair Jay Powell and other key leaders from central banking have voiced cautious optimism as they see the effect on inflation from supply chain disruptions proving temporary. They've been speaking at the ECB's Forum on Central Banking.
This inflationary spike will not lead to a new regime of ongoing higher inflation. The current inflation spike is really a consequence of supply constraints meeting very strong demand.
We certainly have no reason to believe that this price increases that we're seeing now will not be largely transitory.
Excluding temporary factors like this one, the underlying inflation is not so weak as the headline figure.
The preferred tool will always be rates, because we understand the effect. The effect of rates in the monetary transmission mechanism is much better understood. That's not to prejudge what we will decide in November.
Well, we're now joined by Francesco Sandrini, Senior Multi-Asset Strategist at Amundi. Francesco, when you look at some of the things that are supporting equity markets, I don't know whether it's just a belief that margins will be okay and equities keep on rising, or whether there's a firm belief that actually policy will be okay and we're not going to see hikes too soon.
Yeah, that's good morning, Francina. That's a very difficult environment for investors, as you can imagine. We think that there is still a leg up for the equity markets because the growth it's faltering a little, but it's still positive, and the momentum is quite good. The margins of the company, like you have alluded to, are extremely safe because they are quite large in this phase. But clearly, there are the seeds of fragility. The market in this phase is a little crowded out by this persistency of inflation. It's beyond any doubt that central bankers are right in calling the temporal effects of inflation. But the persistency, it's what hurts the financial market in this phase, especially on the margin. So the big point here is the fact that these bottlenecks will not fade away in 1 or 2 months, but they're going to stay for a few quarters more. And the market at some point trades the second derivative of stagflation, that is basically a deceleration on the macroeconomic growth combined with an acceleration of the inflation printings.
But Francesco, we also spoke to Kathy Wood of ARK Investment, and she thinks, the worry is not inflation, it's actually deflation. First, let's have a listen to what she says.
There are a lot of value traps populating traditional benchmarks today, and the value traps there are going to be significant downside surprises because of all of the disruption and disintermediation we see taking place in the world today, thanks to technologically enabled innovation. And so the other this is a combination of, innovation call, but it's also a call on the corporate bond market. Watch out, watch out.
So, Francesco, what would you be watching out for? Is there a risk that actually we think inflation's coming, central banks say it's temporary, and then we end up with a deflationary environment that is extremely sticky to get out from?
Yeah, Kathy is absolutely right. I think that the future, for a lot of different reasons that would be too long to debate, is largely deflationary in the future, or at least with a quite low inflation printings. The problem today, in my opinion, is the fact that we are living with financial markets, and in particular equity markets, that have become a little addicted. The valuations looks quite stretched according to our indicators. And in this environment, after many years of multiple expansion related to 10 years quantitative easing without interruption or almost without interruption, there is this embedded fragility in the system. And clearly, I think that this is not a question of looking at 3 years, 5 years ahead, but this is a question to looking to 1 year ahead. And the market is certainly set for some form of correction that we believe will not be a definitive correction, but will be a temporary correction that perhaps will be a buy the dip opportunity for many investors.
So, Francesco, do you have a favorite asset class right now? Is there something that looks attractive?
Yeah, I think that in this phase of the cycle, normally transitioning from a huge recovery into a mid-cycle, we need to look at quality. We need to look at visibility of earnings. We need to look at safety of cash flow provision. And in this phase, I think it is extremely important to stay balanced. So this is the phase of the cycle where we would like to have quality sectors, where we would like to have a little exposure to growth as well, that we believe is the theme for the next couple of quarters. But there is a problem. There are things that you have alluded to before, like, for example, the relief of the ban from the European Central Bank on the banks for the dividends. There is this increase of interest rates because of this hawkish wave from central banks in the last announcements. Yep. There are the conditions for a little upside for the value in this phase that we believe will be temporary. So quality, growth, we prefer US markets to more cyclical markets, but temporarily the situation may be different for a couple of weeks.
And Francesco, what do you do with China right now? So again, many questions on Evergrande, many questions on what they do with some of the policies put in place that may be good in the longer term, for example, on commodities or coal, but they're actually quite concerning right now. So what's your take on China? How do you play it?
We try to have still some commitment on the government bonds, but at the moment we are a little on the sideline on the equity. The reason is exactly what you said. The Common Prosperity Plan sheds some shadow on the kind of capitalism that China may want to fulfill and achieve in the future. So because of that, it's a little of a falling knife. We see that anytime the market looks for a plateau, then there is a second leg down. That was the case for many companies like Tencent the week before. So we prefer to stay at the moment a little out of China, trying to play some index with a lot of cautiousness, like the CSI 300, that are a little more on inshore China equity.
Francesco, thanks so much. Francesco Sandrini there from Amundi stays with us. Coming up, strategists once again say that sterling is behaving like an emerging market currency. We'll get Francesco's outlook on the UK and UK assets amid pressures on the pound. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Hi, Francine. The EU and US are still divided over tariffs on metals, a dispute going back to the Trump era. EU officials told reporters on the sidelines of the US-EU Trade and Technology Council meeting in Pittsburgh the issue was discussed, but a resolution has not been found so far. Trump imposed tariffs on imports of steel and aluminium in 2018. China's factory activity contracted in September for the first time since February 2020, before the pandemic, as a power supply crunch worsened through the month. The official manufacturing PMI number was 49.6. Non-manufacturing activity picked up, though, with a PMI of 53.2, coming in well ahead of estimates. The International Olympic Committee says no international spectators will be allowed at Beijing's 2022 Winter Games. It says tickets will be sold exclusively to spectators residing in China's mainland who meet virus requirements. The IOC also says athletes who are not fully vaccinated will have to quarantine for 21 days upon arrival in Beijing. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Laura, thank you so much. Laura Wright here in London. Now, the UK economy grew faster than expected in the second quarter of the year, jumping 5.5%, beating forecasts of 4.8%. It comes as the government is due to end its pandemic furlough scheme and other benefits that pumped almost £80 billion into the economy. Let's get back to Francesco Sandrini from Amundi with the very latest. Francesco, more than about furloughs, this is about Brexit. This is a country that has been struggling with, costs, finding drivers. We also have a survey saying that they could lack banks and bankers from outside. Do you see value? Is there anything that you want to be invested in the UK right now?
Yes, but the mist is very high at the moment on UK. Because on the equity side, you certainly we have the FTSE 250 and the FTSE 100 that are trading at a discount versus the other European indexes or even the worldwide indexes as well. And this is extremely attractive to us. At the same time, I think that is pivotal the role of the Bank of England in this phase, because this hawkish bias that has been displayed a while ago has created a little the point I was alluding to before. So we have a strong acceleration on inflation printings, and we have some marginal slowdown from the real side of the economy, especially looking to the retail and looking to the industrial component because of the increase in the price. Things are at margin slowing down. So the market at some point is extremely questioning whether the Bank of England will increase the interest rates, and this is scaring to some extent investors to take too much into the equity markets. On the pound, the market was extremely long before. It was already discounting this kind of rhetoric, perhaps in terms of dynamics and acceleration of inflation. The fear that interest rates could be risen for the wrong reason now creates the conditions for the sell-off, and also the dollar strengthening.
But so what are you expecting how do you expect this actually to end? So, we also have a couple of authority when it comes to foreign exchange markets saying the pound is actually behaving a bit like an emerging market currency. What will happen in the next 6 to 8 months that will settle it either way?
We think that would be quite premature for the Bank of England to increase interest rates, and perhaps the rhetoric will be a little fine-tuned because the situation is not an easy one in UK. And I would say that a lot of the effects are transitory, but rising interest rates in a phase in which these transitory effects, pressures on natural gas, pressures on bottlenecks, pressures even related to Brexit, related to transports, I think that would be advisable to keep a little more of an easing side. And I think that on this basis, the pound will not appreciate further in the next 3 to 6 months and will remain perhaps in a channel versus the euro and perhaps a little weakening versus the US dollar.
So, Francesco, overall, are you expecting a catalyst to actually make the markets correct?
Yes, we expect. It's very curious what's going on because the correction we saw on Tuesday, it was related a lot to this hawkish wave from central bankers led by the Federal Reserve, of course. And it was curious that looking at the flows was very much driven by risk parity players that had to liquidate a little of the equity because of tolerating losses on the fixed income side. But on the same day, we were looking for positive retail flows. And this tells to me the story that the market, as we see today, is still a buy the dip opportunity for many players. And because of that, we think that any correction will be temporary in the region of 5-6%. We are certainly awaiting a correction in this sense, but not yet the time to call the end of the bullish market.
So, Francesco, are you buying dip or equities across the board, or is there a specific industry or a specific country that you're more interested in?
I think that locally in this phase would be advisable not to be too light in terms of values because of the steepening of the curves and the marginal increase on the 10-year notes. And this is something that will be temporary, but sheds the opportunity to stay investing in the short term, also in financials, for example. I would not touch too much still sectors that are more cyclical, like the materials, but for sure all the other sectors that are more related to the cyclical and the value are appealing in the short term. From a broader perspective, we think that this is a phase where the natural transition is towards quality, and because of that, US equities is preferable to more cyclical markets like European equities and Japan to some extent, still light on emerging markets for the reason we discussed before.
Francesco, thank you so much for joining us today. Francesco Sandrini, their senior multi-asset strategist at Amundi. Now, coming up, President Biden pitches his economic agenda to lawmakers at the annual congressional baseball game as the Senate strikes a deal on averting a government shutdown. There's still the debt ceiling to contend with. We'll have plenty more on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Senate Majority Leader Chuck Schumer says lawmakers have reached an agreement to avoid a shutdown of the U.S. government this week. But the debt ceiling issue, of course, still looms large. For more, we're joined by Bloomberg's Kathleen Hunter. Kathleen, thank you for joining us. So what more can you actually tell us about the deal that has been reached in the Senate?
Well, it looks like the Senate's going to vote today essentially on a clean continuing resolution. So that would fund the government through December 3rd. And we would expect that the Senate would pass that, send it over to the House. The House would pass it and perhaps even send it to Joe Biden's desk for signature by the end of the day today. That would avert a government shutdown at midnight, and that certainly takes off the table one of the important things that needed to get done by Congress this week, but it leaves a lot of open questions about how to deal with some of the other elements, most specifically the debt ceiling increase, which had been part of this spending bill, but that Democrats stripped out once Republicans made clear they weren't going to support a government funding measure if it did include the debt ceiling. So it's still an open question what Democrats are now going to do to try to pass a debt ceiling increase. They need to do that by October 18th, according to the Treasury Department. And it's also a bit unclear what the fate of Biden's economic agenda is going to be. As of now, Nancy Pelosi, the House Speaker, is saying that she's going to bring to a vote on today, a vote on the infrastructure, the hard infrastructure portion of Biden's agenda. And it's just unclear right now whether or not she has the votes to pass that in the House.
So, Kat, where does this actually leave Joe Biden's broader economic agenda?
Well, the big question is going to be today whether or not Pelosi is able to pass the first piece of that infrastructure piece that we were just discussing. Progressives have said that they're not going to support it. They're threatening to tank it essentially because they want some broader guarantees on the rest of the package, which is the soft infrastructure, the things beyond roads and bridges. And right now, that's very much up in the air because we don't know what a pair of moderate Democratic senators, Joe Manchin and Kristen Sinema, we don't know exactly what they're going to go for in terms of a top line number. They want a smaller package than what has been put out there. And so really right now we're watching those negotiations very closely to see what happens, whether or not there is an agreement on a top line number for the rest of the agenda and what's going to happen today with this vote on the hard infrastructure package in the House.
So, Kat, if you look at the mood music in D.C., it's getting better, but what's the number one thing what does Nancy Pelosi need to do in the next 2 or 3 weeks to make sure that there's actually something also with teeth for COP26?
Well, I think that obviously there is a very small margin that Pelosi's working with in the House. She can only lose 3 Democratic votes, and that means that getting through things like anything to do with what progressives are asking for when it comes to climate measures. In particular, that's going to be quite difficult. Those things tend to be expensive, and they don't necessarily have the same amount of support from these moderates that are making demands in the Senate. And so really the challenge for Pelosi is she has a very big tent. There's a lot of moderate Democrats, there's a lot of progressive Democrats, there's a very wide range of ideological opinions. And in the coming days, what she's going to have to do is what she's been doing basically her whole career, but with a bigger intensity and with a very narrow margin, is trying to balance all of those different demands and find a way through the center that gets her to 218 votes.
Kathleen, thank you so much. Kathleen Hunter there on DC politics. In the meantime, this is what we're looking at in the markets. Now, there is a little bit of a sigh of relief because of DC politics stabilizing somewhat. That's giving a nice little lift to European markets. Futures also on the high. I guess the concerns out there is some of the data, factory orders, for example, in China, and also, some of the things that we see in terms of inflation expectations. For example, many markets here in the UK expecting 3 interest rate hikes in 2022. Coming up, we talk artificial intelligence with Kai-Fu Lee. This is Bloomberg. Central bank chiefs tried to reassure the markets over inflation, voicing optimism that supply chain hitches will only lift inflation temporarily. Senate Majority Leader Chuck Schumer says a deal has been reached to avoid a U.S. government shutdown this Friday. Key risks to President Biden's economic agenda remain. And how artificial intelligence will change the world in the next 2 decades. We'll speak to AI pioneer and China VC Kai-Fu Lee very shortly. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition on this Thursday, the 30th of April. Now, there's quite a lot of things going on in the markets. We look at inflation expectations. Of course, we look at some of the retail, the ones that are doing well, the ones that aren't. And then we have an agreement on DC politics. So let's get straight to the markets. Our Danny Berger is here in London. Danny, you're focusing on yields.
I certainly am, and we have some yields moving higher today. We still are looking at an equity market that is gaining in the face of those higher yields, which previously had put a dent in the stock market rally. But we heard from Christine Lagarde and Jay Powell, as you mentioned, saying that inflation was transitory, beating that temporary drum. Well, if equity markets are buying it, bond markets aren't. We're still seeing a sell-off across sovereign yields, be it the U.S., be it Germany. Gilt yields peaking above 1%. They haven't closed above this level since May 2019, so we'll see whether or not they could hold. But it's interesting to look at the drivers of these yields. Let me take you into the charts for this, because on one hand, inflation expectations are picking up pretty dramatically in Europe. So that's this blue line here. This is euro inflation forward 5-year swaps versus that of the U.S. In Europe, this metric has hit its highest since 2015. So you have the energy crisis, these things leading to higher inflation. But in the U.S., we've really just been treading water. So in Europe, the story is inflation. That's not the story in the U.S. So what is the story? My last chart for you here is the U.S. 10-year real yield. This has been moving higher. You can see over the past month, we've ticked here above negative 90 basis points. So this is a market that's telling us that the Fed is going to move. They're going to raise rates sooner, and that will keep inflation in check, versus in Europe, there really doesn't seem a mechanism to keep those supply side moving inflationary numbers higher, Francine.
Danny, thank you so much. Dan Berger there with some of the real yields moving. Now, Kai-Fu Lee, a celebrated AI pioneer, former president of Google China, and best-selling author of AI Superpowers, has joined forces with novelist Chen Qufang to imagine how our world will be shaped by artificial intelligence over the next 2 decades. Now, in his new book, AI 2041, 10 Visions for Our Future, he sets out how AI will generate unprecedented wealth, revolutionize medicine and education, and create new forms of communications. He's also a pioneering figure in China's venture capital scene and runs Sinovation Ventures, one of the first Chinese VC firms to have a presence in the U.S. Well, we are delighted to be joined by Kai-Fu Lee right now. First of all, Kai-Fu Lee, congratulations on a book. It's very well written, it's very enjoyable, and you actually break down some of the complicated things about AI and things that everyone can understand. How do you see your AI utopia? How many jobs will be lost? What can machines really replace humans in doing?
Right. Thank you for your kind comments. Artificial intelligence is an amazing omni-use technology that can be used in every industry and is primarily used to do routine things. We usually think of AI as becoming so intelligent over beating people, et cetera, but actually it is particularly good at simple routine tasks. So in terms of job replacement, it will replace routine jobs first. So jobs like telemarketing, telesales, some customer service, people who do desk jobs, copy pasting, reimbursement reports, entry-level HR, finance jobs. And it will also take over a lot of the blue-collar jobs, simple assembly line, moving things around, visual inspection. And also some tasks that we do, like driving, will be done by AI. So when you add all that together, probably in 20 years, half of the jobs and tasks that are routine will be taken over by AI, which is a double-edged sword because it creates a lot of wealth, saves a lot of money, frees us from having to do routine jobs, but it will certainly also threaten the people who are doing those jobs at that time.
It's interesting that you decide actually to look at what the world looks like in AI in 20 years. Why do we overestimate how much the pace of change in technology happens in 5 years and underestimate the pace over a 20-year period?
I think we, as technologists, sometimes just get too optimistic and think that when I see something work in the laboratory, it'll change the world immediately. I have been a researcher in AI for almost 40 years, and I've made that mistake many times. But if you look at more of a 20-year horizon, our lives truly are completely disrupted. If you now think back 20 years ago, what was the internet like? What did we use it for versus all the things we can do with it? It's been dramatically changed. And I think if we look forward, even more things are likely to change because the pace of improvements are very rapid. If you think about the AI advancements, pretty much all the advancements that AI beating the world's champion in Go and chess and able to diagnose cancer for certain types of cancer better than doctors, able to fold protein better than top scientists. All these things happened in the last 5 years. So I think going forward, that accelerated pace of change and given a 20-year time horizon, we will be living in a world that's basically unimaginable today, almost like science fiction.
So, Kailey, if we look at this, AI supremacy and this fight that has been ongoing for over a decade between the U.S. and China, it's unclear at the moment what the final end game of China is with a lot of the crackdown. But is there still a big chance that actually, China will dominate in the space for the future and actually will take away a lot of the resources from Silicon Valley and the rest of the West?
No, I never saw this as a zero-sum game. When I wrote my last book, AI Superpowers, what I predicted was that China would become very strong in AI, comparable with the US, but each with strengths in different areas. And I think we are now seeing that come into fruition. And I don't think that's going to change. For example, today we see US continuing to lead the world in enterprise AI, basically on white collar type of work, enhancement and replacement. US is well ahead with technologies like robotic process automation that is in fact replacing the white collar jobs we talk about. And that with COVID causing jobs to be digitized. Once it's digitized, there's data, and once there's data, AI can work. But on China's side, it's very different. China's core foundation of the economy is manufacturing. So we see a lot more robotics going into manufacturing, autonomous forklifts, smart arms, visual inspection, autonomous vehicles. These are very rapidly accelerating in China, probably in most cases leading the US. So I think each country will do what it's good at and will lead the world. And it's not a zero-sum game. And I think the two countries will continue to lead the future of AI.
But Kailey, if as a pioneering technologist, you need data to process to make sure that your findings are right. And this is a huge advantage for China.
Well, yes, China has a lot of people, and the Chinese people use mobile phones a lot more than Americans. So there's more data feeding into that process, as well as the super apps. I spend 80% of my time in one app in China. So all that data goes into Tencent, and they can train phenomenal AI based on that. But as you said earlier, Chinese government is mindful about internet companies with all the data, will they get too strong? So the same way EU and US have regulated the American giants, I think China will also regulate the Chinese internet giants.
So what does that mean actually for Chinese tech entrepreneurs? Will they be much more cautious? Will it be much more difficult to IPO in the future?
I think most of the concerns are about large internet companies that have great products, brand, users, loyalty, now data and AI to enhance their power. So all of their power is being checked in EU, US, and China. I think that is a one-off thing. Chinese government is very much pro-tech. Well, but the tech here, don't confuse that with Google, Alibaba being tech. Yes, they are, but they also possess the role of large internet company that's being checked. So the AI startups in China are very much the most important, I think, the crown jewel for China, and they're likely to be listed in the next year. If you look at the AI companies in China, I think we'll probably see about 12 or 15 IPOs in the next 12 months or so. And I believe these will be very successful IPOs. These are hardcore, pure AI companies that are building AI technologies and using them to dramatically improve traditional businesses, banks, insurance companies, manufacturing. They're building drones and robots that are changing people's lives. And I think this AI sector, if you want to call it as a sector, in both Chinese and American entrepreneurial economy, in China, these I think will be among the darlings for investment.
So give me a sense, first of all, these would be companies that IPO locally, I guess, because it's so much more difficult to IPO internationally, given what the Chinese regulators have so far said. And how do the Chinese regulators view these AI companies differently? So is it because it has to be beneficial to some of the other industries, or some of the nuances that you're pointing to are extremely helpful for investors?
Okay, well, the Chinese government is actually very, very pro-tech. I think the reason is very simple. Because of the geopolitical issues, the China feels a strong need to have a technological self-sufficiency. So that is why there are incentives and all the ways to help very smart entrepreneurs, whether they're in AI, life sciences, or semiconductor, probably the three big sectors the government is very favorable towards. So, I think there are not currently a lot of companies in these three sectors already publicly listed. But in the next few years, there will be. And I would forecast that, if people who are watching the show believe the Chinese government wants to make a say on favoring some industries and not others, then these are definitely going to be favored, and they will make good investment targets because they will be able to build products that can enjoy not only in the China market, but also Belt and Road countries and potentially internationally. So I think the key challenge, I think, for a lot of people who watch this is when they see China regulating tech, they assume this is negative for all. It's in fact very, very positive for true hard science tech companies, where the regulation target are the large internet companies who use the power of their products and data that can cause problems for fair competition. Those are the ones being targeted. Yeah, I think that the titles can be misleading.
Okay, how big would these companies actually be? And I know you don't believe in a zero-sum game between China and the US, but actually, if you have a big Chinese AI company, does the US feel threatened? I mean, can you really carve out a future where each part of the world has their specialty on AI, or at some point will they have to go front to front?
Yeah, the AI companies I'm talking about, the 12 or 15 that will go public, are probably valued between 3 billion and 25 billion US. So these are sizable companies that are bona fide AI companies. And there will be a whole new set of life science companies, drug discovery companies, and semiconductors companies in that range of valuation. And then I think we're going to see this as an emergent China pure tech play that will be, I think, quite interesting and profitable. And I currently, if you ask me today, I would say that it's likely that the Chinese AI companies will see China as the primary market. The US AI companies will probably not be able to get into China, and Chinese AI companies probably won't be able to get into the US. This is not necessarily my preferred situation, but the geopolitics is such that Chinese AI companies will sell to China, American AI companies will sell to the US, and they'll both compete in other parts of the world, but US will have some advantages in Europe, Canada, Japan, Australia, and so on. And China may have some advantages in parts of Southeast Asia, maybe Africa, maybe other parts of the world. So yes, they will compete, but the fact remains that China and US are by far the largest market, and they will be unchallenged by the other country.
Kailey, thank you so much. AI pioneer, author, venture capitalist, and former Google China president, with this wonderful book, entertaining but also educational. His new book, AI 2041, 10 Visions for Our Future, actually out now. Now, coming up, H&M reinstates its dividend as earnings beat estimates. We're speaking with the chief financial officer, actually, of the Swedish retailer next. Also, we're getting an update on China, with Evergrande paying its first 10% of wealth management products due in September. So I think there's a bit of movement on the Evergrande side. We'll also have a full roundup on China. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. So we're just getting some breaking news out of the Sarkozy verdict. The former French president's facing a potential prison term in the verdict that just came out minutes ago. So let me see exactly what we have there. And I do believe he's convicted. Mr. Sarkozy convicted of breaking campaign financing rules. We understand that the judge, I think, is still reading the rest of the sentence. So it's unclear whether we'll have a prison sentence, but this certainly was what we're looking at, whether the former French president, Nicolas Akouzi, will face a potential prison term in a verdict that just came out saying that he has been convicted of breaking campaign finance rules. Now, H&M reinstated its dividend as the company's prospects improve. The Swedish clothing retailer said pre-tax profit more than doubled in the 3 months through to August. H&M also warning that the global supply chain disruption has been hitting sales. Well, we're joined now by H&M Group Chief Financial Officer. He's Adam Karlsson. Adam, as always, thank you so much for coming on. First of all, congratulations on a good set of results. You're going back to some of the old school things that we used to do in 2019. What are your main concerns going forward? How tight are the supply chains, and how much potential headwind will there be?
Well, good morning, and thank you for having me. I think, as you said, and we are very happy with the performance of the third quarter. It's a sign of our ability to navigate through uncertain times, and I think that we bring with us. Obviously, COVID is somewhat still affecting the whole world and also supply chains around the world. And we've been facing some delays during the summer, but that we're now getting phased out throughout the start of the autumn here. So we look at positively into the autumn.
You ship a lot of clothes from Asia. Are there any price increases or capacity constraints? And how are you looking at the winter months?
Obviously, we are also part of as I mentioned, a global supply chain, and we are dependent on our partners around the world. We have, throughout this past 18 months, strengthened those partnerships. So we believe that we can work as very strong business partners and find ways to mitigate some of these challenges. So we're looking positively towards the autumn and into the winter.
How's China doing? I know China sales were down some 23%, maybe because of some of the social media backlash. Are you back on track?
Well, we don't comment on China specifically. It is a complex situation that we follow closely, but as previously mentioned, we don't comment specifically on China.
Okay, can you give us some of the, if you look at some of the product delays, have they affected certain countries in the summer more than others? And actually, what are some of the steps that you took to try and mitigate that?
There are some combinations of leaving ports and receiving ports that are more hit than others. Some of the ports in the U.S. are more heavily congested, for example, so that we're then mitigating by shipping the goods slightly earlier. So we have a proactive plan that we put in place over the summer that we're now executing on.
Can you give us any idea of some of the openings of stores or some of the closing stores that you'll see in 2022? What does the next 12 months look like?
We still see the store estate as a huge asset for us, and that I think is just once again confirmed by how the recovery is now coming into place. So we have celebrated opening in some new markets, for example, Panama here just recently, and we're looking into a couple of new markets also going ahead.
So what does that mean for, the fact that you reinstated a dividend and you had some pretty good earnings? Do you think you're out of crisis mode? What does it mean for the future?
It is a sign that we maneuvered these uncertain times really, really well, that we are agile, we're able to take the needed actions. But of course, we're also humble looking ahead now. So it's not fair to say that we're out of the crisis as the world is still affected by the pandemic, but it's a sign that we managed to navigate in a good way.
What's your biggest priority or your biggest concern over the next 12 months? I know you don't want to comment about China. Is that because it is China that you need to try and figure out now?
No, but we want to go back to normality in all aspects. Obviously, that we can welcome our customers in our stores. So that's a big priority for us, and also then evolving the whole customer experience. We've taken huge steps before, and now we're continuing on that journey, integrating the channels, working with the supply chain, and ensuring that the customer gets the best customer experience all around the world.
What does a new normal look like? Will the pandemic actually change the way we shop forever?
I think we have welcomed a lot of new customers, and also customers have found ways to shop with us in new ways. So I think the new normal will be a combination of the good things that we saw in the past and some new findings, also when it comes to how customer behaves and how we use the digital tools, all the way from shopping to how we meet and integrate. So I think we have a strong base to stand on and some strong learnings from the last year and a half.
All right, thanks so much. Adam Karlsson there, the Chief Financial Officer of H&M Group, with some of the earnings and reinstating dividends this morning. Now, we're looking at what's happening in France at the moment. Just moments ago, we had the verdict on Nicolas Akouzi. It's taken quite some time, actually, for the verdict to come out. The French ex-president, Nicolas Akouzi, has been found guilty of illegal campaign financing for his unsuccessful 2012 bid. So we'll have plenty more on that. Unclear at the moment for me, but maybe producers have a little bit more of an idea whether he will go to jail or not. This was talking about a prison sentence. I don't know whether there's a verdict on that or whether we just need to wait as the judge continues reading. I understand in France what will be the fate of Mr. Sarkozy. The judge says Nicolas Akouzi was warned of overspending. He says he deliberately broke campaign financing limits, and therefore he is now convicted of breaking some of these campaign financing rules. Now, to the markets. A lot going on in the markets. This is as stocks are extending gains. We did have quite a volatile quarter. It's nearing the end. Tomorrow, a reminder, it's not only Friday, but it's also October 1st. Now, some of these global global stocks are rebounding. The positive news out there is that the debt ceiling deal in Washington, but also central bank assurances about transitory inflation, boosted optimism about the economic recovery. What I would be cautious about is some of the data coming out of China. Now, Asian stocks actually rate losses. We did see some gains in China before a week-long holiday, and yet the data wasn't as good as expected, certainly when it came to factory orders. So global stocks poised to end the quarter with a small loss after a 5-quarter rally. Investors again bracing for the Fed to wind down its stimulus. They also remain concerned about slowing growth. They remain concerned about elevated inflation. They worry about supply chain bottlenecks, an energy crunch, and of course, regulatory risks emanating from China. In fact, the majority of participants in a Citigroup survey say that a 20% pullback in stocks is more likely than a 20% rally. Bloomberg Surveillance Early Edition continues in the next hour. Danny Berger will be joining me here in London. Kailey Leinz will be in New York. We'll have all of the market moves. We'll also bring you some insight from some of the bankers we spoke to yesterday. Dip buying continuing this Thursday. Miners pacing the gains. Iron ore climbing. I'm looking at technology stocks battered earlier this week, also extending the rebound. Then we look at Senate Majority Leader Chuck Schumer saying that lawmakers has reached an agreement to avoid a government shutdown. This is Bloomberg.
We realise that there's a lot going on to digest. It's very political, this whole debt process, the whole infrastructure bill, and indeed everything that's happening at the central bank in the US. Very political process behind that.
The Democrats are trying to thread a very, very thin needle hole with getting infrastructure through, the human infrastructure, and raising the debt ceiling. Everything has to go according to plan, and it's going to be pretty messy.
Biden's overwhelming priority, and everyone is rowing in the same direction on this, is ensure that the progressives, as well as Manchin and Sinema in Senate, get together to get these trillions of dollars done.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong this Thursday, September 30th. Our top stories today. Last-minute maneuvering on Capitol Hill. Congress is set to avert a government shutdown with just hours to spare. But Democrats are still deadlocked over President Biden's economic agenda. Fallout from Evergrande debt crisis. China tells bankers they need to support the rapidly cooling housing market and help mortgage holders. And what comes next? Investors add up their wins and losses from the third quarter. We'll look at the risks to the global economy and what it faces in the final 3 months of the year. Well, good morning, everyone. I'm Francine Lacqua with Danny Berger in London, Kailey Leinz in New York. Matt Miller off this week. Kailey, the markets, of course, they're worried about energy prices. They're worried about supply concerns. But because we had the government in the U.S. averting government shutdown, they're rising today.
Yeah, that may be aiding risk appetite, certainly when it comes to U.S. futures, and we're seeing some positivity in Europe as well. But Asia ending the third quarter a bit mixed. You did have stocks down in Hong Kong and in Japan. China, though, up 0.7%. Of course, it is the last day of trading in China before a week-long holiday, and there's many things that the market had to digest. On the one hand, you had manufacturing PMIs for the month of September in contraction territory for the first time since February of 2020. It shows that power crunch that you were alluding to, Francine, is biting manufacturing activity. Of course, the other thing China has to worry about is the ongoing crisis with Evergrande and the property sector. We got news overnight that the PBOC has asked 24 banks to help shore up the housing market. That lifted property stocks broadly. Evergrande, though, did fall today, down about 4%. Two holders of its dollar bonds that had a coupon payment due yesterday said they have not received anything. Elsewhere, the Chinese yuan is a big outperformer in Asian FX today, stronger against the dollar by about 0.2%. And iron ore up 3% in Singapore, maybe traders trying to get a little buying in ahead of the holiday. Now, as for the picture here in the U.S., we did see dip buying yesterday, but it really wasn't very strong. And actually, we saw selling into the close, the S&P 500 only ending Wednesday 0.2% higher. So we will see if the gains we are seeing early on today can indeed hold. Right now, S&P 500 futures up about 0.7%. The bond market steady as she goes. We're essentially unchanged on the 10-year yield. 152 is where we sit. We are seeing a weaker dollar today, coming off of its strongest level since November of 2020. That affecting dynamics really across asset classes. And then I would point to crude trying to rebound after 2 days of losses. Danny, WTI back north of $75 a barrel.
Of course, within all of this, we have to keep in mind it's not just month end, it's quarter end too. So we might see some window dressing that makes assets move and behave how we might not expect them to. Well, in the UK and rest of Europe, we are taking a bite out of that month to date loss. It is very tepid gains, I should say. And as we've gotten through the session, we're now about 2 hours into the cash equity trading session. These gains have started to peter out. We see things like autos underperforming. So the DAX only up 0.2% versus, for example, the CAC 40, which is up 0.6%. UK outperforming. A lot of that is the material stocks doing well with iron ore on a tear. That's related to China mills stocking up before the holidays. So some uneven performance, but generally green across the screen. So here's where your benchmark index is up 0.7%. But really the macro picture here when it comes to cable and the UK 10-year yield has to do with this concern over stagflation. Is the energy crunch going to mean that inflation goes higher, but central banks can't handle it? Well, that allowed cable to break below 135 yesterday. We're still below that level, just up 8 basis points. That mostly has to do with a weaker dollar more than anything. And your UK 10-year yield up above 1% yet again. It hasn't closed at this level. Last time it did was May 2019. Boohoo really does factor into all of this. It is an online fast fashion clothing retailer. They had done well during the pandemic, but their shares are falling more than 10% this morning. They had earnings and cut their sales outlook, and they're forecasting supply chain issues are weighing on us. We can't get the goods we have to meet demand. It really is this bullwhip of demand that a slight change in how much consumers want means supply chain issues. Francine, this is also an issue for H&M as well, and I know you spoke to the CFO this morning.
Yeah, and look, a lot of concerns that actually the market is also reflecting for the chief executives. It's supply chains, it's energy crunch, it's, of course, regulatory risks also emanating from China. Now, look at what else is ahead today in the U.S. The Senate votes on an infrastructure package that underscores deep divisions amongst Democrats. The UK furlough scheme ends, which has been supporting people who would otherwise have lost their jobs during the pandemic. The ECB's recommendations to cap dividends and buybacks are due to expire, which could lead to a surge in bank dividends this year. At 10 a.m. New York time, also the House Financial Services Committee holds a hearing on the Fed and Treasury's pandemic response. The Fed Chair Jay Powell and Secretary Janet Yellen are expected to testify. Also, transport and health ministers of G7 countries are set to meet virtually to discuss ways to restart international travel, while the meeting is being organized by the UK, which holds the presidency of the G7 nations this year. Now, onto one of our top stories, China urging bankers to help local governments stabilize the rapidly cooling housing market and ease mortgages for some home buyers. Now, this is just another signal that authorities are worried about a fallout from the debt crisis at Evergrande. Let's get more with our China expert, Tom McKenzie. So, Tom, it seems that actually we're getting a little bit more news on really how critical the Chinese authorities want to save Evergrande.
Yeah, the policy response is becoming more sharply in focus. There's still a long way to go. It's taken a lot of time. It's taken a lot of pain as well. But what we do have is this meeting then by the central bank governor, Yi Gang, along with securities officials from the housing ministry saying, look, sign off on mortgages from mortgage borrowers who are good to go, and also make sure that property developments that are already under construction, that they continue to lend to those developers where they are building out projects, because we know that 1.6 million households or individuals in China have put down deposits on houses that have yet to be built. So it follows on from the local government yesterday stepping in to buy that stake in a bank that Evergrande owned. So shoring up the banking system, but ensuring that the developers who are working to build out their properties are getting the credit that they need. By the way, Citigroup pointing out that 40% of China's bank assets are in some way linked to the property sector.
And then there's the macro issue of the data we got this morning. China PMI showing the first manufacturing contraction since February of 2020. I was surprised, though. Stocks didn't move much. Bonds didn't move much. Why the muted reaction to this?
Good news is bad news. I think probably the assumption that the PBOC is going to have to do more than just get officials in one room and get them to encourage to open up the spigots on credit, at least marginally. It's about the triple R and whether or not, and other policy responses. Triple R seems to be the consensus view. You're going to get another cut to those reserves, is the view from some economists, because the economic pain is very acute now. And you're absolutely right. We saw that in this manufacturing data for the first time contracting, at least since the pandemic. Services was still in expansionary territory, but there's a long way to go there. The restrictions around COVID has held spending back. So you don't have the consumer back in full force. You don't have manufacturing back in full force. And of course, the real estate sector under pressure as well. That's leading to many to downgrade their views on China's economy.
The consistent assumption that easier policy will come to the rescue. Thank you so much to Bloomberg's Tom McKenzie. Now let's head over to Washington. Congress and President Biden are set to avoid a disruptive shutdown of the federal government with just hours to spare. It's the eve of the new fiscal year, and the Senate and House are expected to vote to extend government funding until December 3rd. Jack Fitzpatrick, Bloomberg government reporter, joins us now from Washington. So Jack, maybe we're close to a victory on one battle, but there are other battles ongoing, including the vote on the bipartisan infrastructure package in the House today. The question is, are the progressives going to tank it?
The progressives are going to try to tank it. The outstanding question on the infrastructure vote is, could enough moderate Republicans join and support this? We don't have an exact whip count, but it looks like things are probably leaning away from a clear ability to actually pass that infrastructure bill, because there are a number of progressives who are still trying to block it. And the only thing that was going to get them on board if there was significant progress made on the $3.5 trillion reconciliation bill, which has not happened. So that two-track process is still an issue, and it's still not going very well because of how slow things have moved with the other larger bill that Democrats want to pass.
So, Jack, what's the next step?
The next step on reconciliation and infrastructure is to try to get the moderates, Senators Manchin and Sinema, to try to give them a top line and say, if not $3.5 trillion, what exactly do you want? The problem with that is Senator Manchin and some House moderates have said, really, we just want to slow this down. They haven't been specific on exactly what they want, and they want the process to not go absolutely pedal to the metal right now. So the timing of trying to link up the infrastructure bill and the reconciliation bill might not be possible. We'll see if it's possible to actually pass the infrastructure bill today. That's not absolutely ruled out, depending on Republican votes. But things are really gummed up right now because Senator Manchin and Sinema in particular have not been really specific about what would get them on board with the broader legislative agenda.
Jack, thank you so much. Jack Fitzpatrick there of Bloomberg U.S. government. Now, the UK economy emerged from the winter lockdown stronger than expected. More recent data, though, suggests that the pace of the recovery is actually fading. Let's get more now with our Bloomberg UK economics reporter, Lizzie Burding. Lizzie, first of all, energy out of control, but actually in the past, the economy was better than expected.
Yes, we had the second quarter GDP print this morning. As you can see, the economy grew 5.5%, more than the 4.8% that was previously expected. But the recovery is running into trouble because of the material shortages, as you say, because of the rising COVID cases. So the Bank of England last week downgraded its forecast for the third quarter to 2.1%. And economists say that its forecast for the fourth quarter is looking increasingly optimistic. At the same time, traders are now pricing for 3 rate hikes in 2022. So I don't envy the Governor Andrew Bailey's job of having to keep a lid on inflation while not choking off the recovery.
Certainly a very careful balance. And at the same time, Lizzie, today we're losing the support of the UK furlough. What will be the impact of removing that support?
Well, for the million or so people who were the last left on furlough, the future really is uncertain. We've had warnings for months of a spike in unemployment, but the latest jobs data don't reflect that. The Bank of England doesn't expect that. The hardest hit are likely to be older workers on lower incomes who will be pushed into early retirement. But don't forget, it's not just the furlough scheme that's ending, it's also the £20 a week uplift in universal credit. 6 million households, 6 million individuals were benefiting from that. So ending the two measures at the same time piles pressure on household finances, and it means that the supply disruptions we've been seeing could combine with weaker consumer confidence, lower household spending, and stick the economy into reverse.
The normalization of pandemic policies is definitely going to be difficult. Thank you so much to Bloomberg's Lizzie Burden. Let's get back to the markets now and take a look at some stocks moving in pre-market trading here in the U.S. I have to begin with Virgin Galactic, of course, Richard Branson's space exploration company. If you remember, the FAA grounded Virgin earlier this month because it was investigating a deviation from its flight path from a flight back in July. The FAA last night saying, though, that investigation has concluded. Virgin can fly again, and as a result, those shares are flying in pre-market trading up about 10%. Another mover to the upside is Lordstown Motors, of course, the electric truck startup. It is selling its factory in Ohio to Foxconn, which is a manufacturer for Apple. That could help the company raise some cash, which it basically really needs. So that stock is up 6% before the bell. And another big mover to the upside is Perrigo, which makes over-the-counter drugs, self-care types of products. It has settled a tax dispute with the Irish government. And an analyst over at Jefferies says that resolution actually is very favorable. That stock is up about 14% before the bell, Francine.
Kailey, thanks so much with some of the pre-movers there. Now joining us shortly, John Hardy, Saxo Bank head of FX strategy, and then later on the DC drama, we'll speak with Julie Norman of University College London. We have you covered for any dollar move. We look at sterling, and of course we look at DC. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Francine Lacqua in London alongside Kailey Leinz in New York. I want to kick us off with a market conundrum, just a quick FX 101 lesson. Typically in developed economies, when yields move higher, so too does the strength of that country's currency. But something is awry when it comes to these UK markets, and I want to welcome our radio listeners as well. I have a chart next to me, and I will explain to our radio listeners what the chart is. I have two lines on here. One is cable for our TV viewers, that's in the white. The other line I have on here are gilt yields, specifically the benchmark 10-year yield. And you can see this relationship typically does hold up, and it has for most of the past year. However, over the past few weeks, it is a stark divergence. We've had cable decline, falling below 1.35 for the first time since January. And at the same time, just today, we had that 10-year yield tick up above 1%. So this is a broken correlation, and it's just happened recently as we have these energy issues waffling through the market. We had Adam Cole over at RBC saying that now cable is trading more like an emerging market currency. So what is all behind this? Let's try to get some answers. Let's go to our Noor Al-Ali, our Bloomberg M Live editor, who joins us now. Noor, thanks so much for joining us. So what do you attribute this divergence to?
Well, realistically, when it comes to the pound right now, it's a story of two folds. There's the local end of it, what's happening in the economic growth in the country, and also the dollar strength there, really pushing the G10 majors down, and also emerging markets.
So you could argue, Nora, that actually BOE is the most exciting central bank out there, with money markets also expecting 3 hikes in 2022.
Yeah, I mean, there's that. But also, Andrew Bailey came out yesterday and said, well, listen, let's not be too excited about what we were excited about 2 weeks ago. Let's just, slow down that growth there. Because the GDP data that came out today was for the second quarter is really reminiscent of the Euro 2020. So even though it was revised upwards, it's coming home chanting right behind you. So what I'm really interested in seeing is whether or not the economy can rebound after the furlough scheme ends. And that's happening today. So let's see what goes on in the quarter ahead.
Nor, speaking of the economic data, we got some out of China overnight, a contraction for manufacturing PMIs for the first time since February of 2020. Why is that not sending more of a warning signal to risk assets?
Well, currently, any time an economy would contract, the size of China is very concerning, especially when it comes to commodities. That, for me, is a signal that they may struggle, because that means imports may decrease and what have you. But you still have the energy crunch out of Europe and Asia as well. And I don't think it has extended as far as much to the U.S. because you've got LNG supplies there. But that energy crunch is a much greater story right now. It's a lot more temporary because we're expecting that strength to kind of decrease freeze as the winter goes through. But so far right now, we've got the energy crunch really supporting crude prices through this.
So if it isn't really being felt in the U.S., is it fair to say that the markets view this as the Fed being able to control inflation, while in the rest of the world, UK, ECB, they can't?
Well, no, look, I never want to say the ECB can't do something on record.
Very diplomatic.
But here's the thing. You are feeling that stretch of inflation a lot stronger in the euro area. So you've got break-evens out of France and Germany really not skyrocketing, but increasing. They have come off a little bit today out of the German 10-year break-even rates. But realistically, what we've got here is an ECB, a bank that says, we're not worried about that inflation spike, whereas the Fed has given us that hawkish tilt. Obviously, you've got the non-farm payrolls coming up next week, and that's going to give us the biggest and truest test of whether or not the U.S. economy and employment has rebounded.
We have to get you back. We haven't even talked about deflation, nor what's going on, nor our leader from our MLive team. Now, for more market analysis, check out MLIV Go on your terminal, one of the smartest voices around on inflation. This is Bloomberg. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua with Danny Berger in London, Kailey Leinz in New York. Now let's get straight to the Bloomberg First Word News. And the Federal Reserve Chair, Jay Powell, and his international counterparts have renewed their assurances that a surge in inflation is temporary. Now, at a virtual panel hosted by the European Central Bank, Powell said the spike is really a consequence of supply constraints meeting very strong demand. Well, he said that's all associated with the reopening of the economy. The G7 economy is also looking for ways to restart international travel. Well, Bloomberg has learned that transport and health ministers will meet virtually today. The meeting is aimed at moving closer to a consensus on how to ease border restrictions. While some countries, including members of the EU, have used so-called vaccine passports, others, like the US, have held back for reasons ranging from politics to privacy. And in France, former President Nicolas Akouzi has been convicted of deliberately overspending in his failed 2012 re-election campaign. Now, a criminal court found that Sarkozy spent roughly $50 million, about twice as much as was legally allowed. Prosecutors have asked for a 6-month sentence. Earlier this year, Sarkozy was convicted of corruption. So we'll have plenty more, of course, on that. And the UK is suffering a shortage of truck drivers. Now, lobbyists in post-Brexit Britain warn there may not be enough bankers. International staff make up a fifth of the 1.1 million people working in UK financial services. According to lobbyists and consultants, Brexit is making it harder and more expensive to hire foreign staff. I don't know about you, Danny, but actually I hear so many people that went back to Europe, and it's builders. There's definitely going to be a supply crunch on many more industries than just energy.
And I'm not sure how this goes down in the Lacqua household, but of course, Paris is becoming kind of the new beacon for investment banks. Everyone from JP Morgan to Goldman Sachs, Morgan Stanley saying, hey, if you're going to come work for us in Europe, don't go to the UK, come to Paris.
Yeah, and then other banks choosing Frankfurt, which may be a little bit of a tougher sell. Maybe Kailey goes to Frankfurt because you have more regulation. I mean, it's one of the fun dinner party questions, Kailey, here in the UK, is if you had to go anywhere because, you lose the clearinghouse in London, where'd you go?
I think I'd pick Paris. Just better food, I feel like.
Kailey, Francine and I are in London. We're going to have to revisit this answer.
Right? Isn't that the point of the question?
Yeah, so maybe Madrid.
Okay, fair.
There's been a big push to try and get bankers to Madrid. Up next, John Hardy, head of FX strategy at Saxo Bank. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Kailey Leinz in New York. Matt Miller off this week. Danny, we look at the markets. It's the end of the quarter. We look at some of the worries, supply crunch, energy concerns, of course, inflation may be coming back. But we have a bit of positive news out of D.C.
Yeah, we certainly do. That's helping risk sentiment here, that at least we're not heading towards a shutdown. Of course, the debt ceiling is still an outstanding issue. This is something that traders and investors typically don't care about because it has a way of sorting itself out. So that remains on the back burner. But for now, it's just the unknown of the fourth quarter, bringing a lot of uncertainty into this market. Unknown about inflation. Could it be stagflation? And now, Francine, calls are just piling up across the board that we could see a correction or at worst a 20% drop in these equity markets. At least that's what the latest Citi survey of their clients says.
Yeah, and we look at yields as well. Kailey, how's it all playing out in today's markets?
Well, it doesn't look like a correction is on deck today, Francine and Danny. I would note today is day 230 trading days in which the S&P 500 hasn't seen a 5% pullback. Now, here in Europe, or out there in Europe, where you guys are, I should say, we are seeing gains, though the stock 600 is off session highs. It's only up about 0.5% right now. It's really basic resources and energy leading the way in the session. Here in the U.S., S&P 500 futures are in positive territory to the tune of about 0.6%. The question is, come the open and through the trading day, will those gains hold? Because they've had difficulty doing that as of late. We go nowhere right now on the 10-year Treasury yield, literally unchanged, just shy of 1.52%, but a little bit more action happening in Bitcoin. Just keep an eye on it, up 5% today, back north of $43,000. And with that move in Bitcoin, we are seeing some subsequent moves in Bitcoin-related equities. Marathon Digital, Riot Blockchain, MicroStrategy, Coinbase Global, all higher to the tune of 2 to 4%, Danny.
Well, Kailey, I want to talk about King Dollar. It might be a little bit weaker today, but it still has its crown. I also want to welcome our radio listeners as well. I have a chart up that I'll explain to you. 2 lines on the graph. You have the Bloomberg dollar spot, and you have that dollar spot's 1-year risk reversal, essentially where the wind is blowing in options in terms of bullish or bearish. Now, you can see this continued uptrend for the dollar over the past month. Again, for our listeners, it has been pretty strong as it shows on this chart. And the momentum doesn't look like it's going anywhere for the dollar. And that can be seen or really enforced through what the options market is doing. The risk reversals are also very elevated. At the moment, they are at 70 basis points. It is basically more demand for topside options. And the most bullish these options, Francine, have been since June of 2020.
Yeah, if you look at some of the rise, of course, in the dollar, between June and actually the 3rd of September, it was 4.3%. And some people also say that that could point to cheaper crude, which we're not seeing at the moment. John Hardy, Saxo Bank, head of FX strategy, joins us now. John, what's your dollar call?
Well, I think the dynamic here we're looking at is the market is looking at the Fed normalizing. We're looking at U.S. Treasury yields, and those processes are supporting the dollar. This sense that the EU fiscal outlook is sidelined, that the major excess savings countries are sort of recycling their savings into a country which is about to tighten policy, that is the U.S., is supporting the dollar. So I think this process could continue a while. I think interesting, the move yesterday, there didn't seem to be any specific prompt to it. Some would argue that means it's of better quality than otherwise, but we are at quarter end here, so I'm curious to what degree this quarter end effect may have caused a bit more of an acceleration than we might otherwise have seen. Yeah. So we'll see how this the dollar finds its legs early next week as we look forward. I think the sooner we get to a German coalition and EU fiscal impulse, the quicker euro-dollar bottoms out.
So, John, what's your focus when you look at the markets? It seems we've seen so much volatility on pound. How much more volatility could we see, and actually, where does it settle?
Yeah, I have some concerns about sterling. We have this sense there's been quite a change in sentiment around sterling with this big energy crunch. I think some of that is justified. The sense that there's capacity constraints, some of that linked to Brexit, some of that linked to the structure of the economy and excess demand injected into the economy during the pandemic relative to the labor that is available. And we have that sense of labor shortage. So it just seems that with that constraint, with the energy crunch, with the sense of isolation and vulnerability, and a government looks like it's headed towards some attempt at fiscal credibility and therefore austerity, these are not supportive factors for the pound. I think traders were very much offside post the German election, which nominally should have looked like a slight euro negative, and it wasn't. So I think euro sterling looks interesting as sort of a key of where sterling is relative to where, whereas sterling versus dollar is more about the U.S. dollar right now.
Given the hawkish turn of the BOE, is this pound weakness not overdone?
Well, that's what's been interesting, because that hawkish drumbeat has been there for quite some time. in the background, and nonetheless, sterling was really indifferent to it and not trading off of that. I think it's these other considerations that I just listed up that are more more what is impacting sterling at the moment. So yeah, I have concerns about the sterling devaluing a bit more here.
And then when we look towards China, John, there is some conversation now that the weak manufacturing PMI print we got overnight just means easier policy. So how do you think about the yuan?
Well, I think about the yuan as being extremely managed. We've noted in recent days, of course, with this big surge in the U.S. dollar, the renminbi is virtually unchanged, suggests a highly managed exchange rate. Maybe some of that stability is desired on the part of officialdom ahead of their big long week, holiday week here through next Thursday, starting tomorrow. But I think on the other side, you have capital inflows that have been sort of chased away by this huge policy shift and the uncertainties that it has generated. So, theoretically, I think we should be seeing a somewhat weaker Chinese renminbi, but the question is to what degree market forces would be allowed to affect the exchange rate. Their commodity import prices, of course, are soaring now, especially on the energy side. So there is some justification for keeping a strong renminbi on that front. So it's what the officialdom wants to do with it. I think the underlying fundamental pressures are for a significantly weaker currency and a need to ease eventually.
Right. Right, and you mentioned the strong dollar there. I want to bring it back to the greenback. The start of this year, we had very short positioning. That started to flip. Where are we now, John? What does it tell us about the pain trade?
Well, the pain trade is still higher on the dollar. We've seen a lot of that positioning has been reduced, certainly. But there's certainly more on the pain side, especially the longer we get this sense that we're in perma-QE and the big excess savings economies, Japan, in Europe, and as long as there's this big differential stretching out over the horizon, I think it tends to feed a stronger dollar. If we get EU fiscal back on board early next year, if we get fiscal uncertainty in the U.S., which I think is coming fast and furious, if you will, I think that the move does peak out and we start to roll over and see a weaker dollar before the end of the year. I could be wrong by a month or so on that, but that's my anticipation that we see a turnaround and a pivot sometime in Q4.
So does that mean those yield differentials then are more important than capital flows?
It's both. I think you would need to see because monetary policy seems so stuck in the mud in the other zones. You need to see the fiscal policy coming on board to encourage a positive. Certainly in the case of the euro. The euro is too cheap, but we need to see something on the political front. Breaking of the logjam and some stimulus that keeps capital at home and investing domestically. Maybe this energy crunch is the thing, and it should be the thing. This is a galloping crisis that prompts more action from the EU politicians from here. It seems to be they seem to be sort of sailing cluelessly along here on this issue. We need to see some political leadership to address that issue, certainly.
Thank you so much, John Hardy there of Saxo Bank with the very latest on some of his FX calls. Now, Nicolas Akouzi was convicted moments ago of deliberately overspending in his failed 2012 re-election campaign by French judges. What we found out moments ago, it takes quite a long time in France for the judge to actually read the verdict. He will get 1 year jail term in overspending case, but actually he will not actually be in jail. So I think he just has to wear an electronic bracelet, which means that he could probably stay at home. It's really another humiliating defeat for Sarkozy, who was convicted of corruption earlier this year, but he does remain still quite influential in France, well-liked amongst right-wing voters. We'll have plenty more, of course, on France and the upcoming election next year. Coming up next, though, Julie Norman, University College London lecturer in politics and international relations. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, Representative Catherine Clark, Democrat and Assistant Speaker of the U.S. House of Representatives. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Kailey Leinz in New York. Now, President Joe Biden is making his pitch to both parties on Capitol Hill. Last night, the president attended the congressional baseball game where he distributed Dove ice cream bars printed with the presidential seal to the players. Well, Biden is poised to avoid a disruptive shutdown of the federal government, but deal-making continues on his economic agenda. Well, joining us now is Julie Norman, teaching fellow in politics and international relations at UCL. Julie, thank you so much for joining us. Look, there's progress. At least we don't have a government shutdown for tomorrow. How difficult will it be to actually, keep Democrats all on side?
Well, Francine, there's a lot going on in Washington this week, and you're right that the most urgent crisis will most likely be averted. We'll probably avoid the shutdown that would have otherwise occurred tomorrow. But for Democrats, there are still two big bills that are in play, and we see this rift that's kind of been there between the moderates and the progressives just growing ever wider as we lead up to these votes. It's expected today that there will be a vote on the $1.2 trillion infrastructure bill. This was the bill that was a bipartisan bill, had 19 Republican votes in the Senate, has been sitting with the House for several weeks now, and is just waiting for their vote. Many of the progressive members of the Democratic Party have said that they will not support this bill unless it's moving in tandem with the Democrats' much larger spending package. And so they are trying to get some movement on that before committing their votes.
Yeah, so Julie, help me understand the progressive calculus here. I'm trying to figure out how it is more politically advantageous to risk tanking President Biden's entire economic agenda than it is to risk maybe having $1 trillion less in social spending if they vote for the bipartisan package first.
Well, that's exactly right. What we've seen progressives trying to do is use their leverage as much as possible in the lead up to this vote. They're trying to push for some kind of concessions, either a number from moderates or a kind of legislative plan before committing to the infrastructure bill. But at the end of the day, if they don't support the infrastructure bill, if the infrastructure bill dies, they will have very little leverage moving forward after this. They will just get more animosity in terms of passing the spending bill, and it will actually hurt their case in the long run. So we see them trying to maximize their leverage today, but when the bill actually comes up for a vote, it's in their best interest to move that forward, to move the whole party forward.
Does this issue resonate with voters? Julie, is it go beyond not getting this economic package passed, but also impact the midterms?
Well, that's certainly a concern for many Democrats, and that's why we see the progressives on the one hand really pushing down for what they see will be popular in their districts, some of the policies that are part of the larger plan, such as early childhood education, different kinds of tax credits, climate, et cetera. But at the same time, many of the measures that are in the infrastructure bill are also just crucially important to those same districts and districts across the country. Traditional infrastructure such as roads and bridges, but also broadband, clean water, and other issues that are really quite pressing for individuals across the country. So while this is politics playing out, it's also real policies that matter for many Americans in both progressive and moderate districts.
Julie, who are the senators you actually want to hear from? So apart from Manchin and Sinema, is there anyone else that we need to find out exactly what the thinking is on the tax position, but also on the spending bill?
Well, Francine, for right now, the two senators that are getting the attention are Sinema and Manchin, of course, and they are the two that I think are going to be the real deal makers on supporting the larger bill. And Manchin made a pretty long statement yesterday, referring to the fiscal insanity of the current Democratic plan and really pushing for weeks, if not months, of negotiations around that. So he and Sinema are really going to be the two senators that we're focusing on. There's several House moderates as well that have been pushing for a bit more clarity around the infrastructure bill and around the stimulus bill. And so this isn't just limited to the Senate, but right now Manchin and Sinema are the go-to people to make this happen in the upper chamber.
Julie, obviously it's Congress that can make or break this long-term economic spending plan. But at the end of the day, this is President Biden's agenda. What does the Biden administration do if Delta loss here?
Well, that's exactly right. This is two key pieces of Biden's agenda in terms of big policy initiatives, but also in terms of the process. The infrastructure bill in particular is a key piece of legislation, but it's also a key piece of bipartisan legislation. And it's really important for Biden that gets through to show that he was able to make bipartisan deals work. The larger spending bill is also really crucial for Biden. Again, Democrats, I think, realistically know they have until really the midterms of next year to get something big through. That package includes a lot of the many more progressive policies that Biden and the party more largely want to see move. And so these two pieces together, but especially I would say the infrastructure bill, are very crucial for Biden right now. He's coming off a low period with the Afghanistan withdrawal, approval ratings at the lowest that they've been since his time in office. He needs a win.
Julie, from our point of view, where we sit looking at the markets, the concern over the debt ceiling has been pretty minimal. Where would you put the odds that we do indeed breach the debt ceiling?
I think both parties and the Democrats right now controlling Congress know that cannot be breached. Something needs to happen to prevent that, and I think they will make the necessary steps. We've seen Republicans making that difficult for Democrats this week, blocking several of the measures that would have already had it go through. Democrats may, in fact, be forced to use the reconciliation process to raise the debt ceiling. It's not something they want to do. It's not politically palatable for them. But if that's what they need to do, they will do it. I think we've heard very clearly from Secretary Yellen some of the risks that are involved for the larger economy as well as for taxpayers, and no one wants to see that happen.
Julie, thanks so much. Julie Norman there of UCL. Now, coming up on Bloomberg Surveillance, Bob Woodward and Robert Costa, co-authors of the new book, Peril, which details the transition from President Trump to President Biden. That interview at 8:30 a.m. in New York, 1:30 p.m. in London, and this is Bloomberg.
Think of people whose jobs have now been displaced by this big step that business has taken to digitalization, who have no financial assets to begin with, so they didn't benefit from what has happened to asset prices. And in addition, they were hoping to buy a house and they've been priced out of the housing market. So suddenly both their actual and potential wealth and income has declined.
A Bloomberg opinion columnist Mohamed El-Erian discussing inequality caused by the pandemic. Now, El-Erian is one of the three Wall Street titans featured in today's Big Take on the next big risks for investors. Now, talking about big risks, Tom Keene, co-anchor of Bloomberg Surveillance, joins us. And Tom, you're looking at the S&P.
Well, I'm looking at the S&P and the Dow. The S&P is way more accurate in terms of the wholly holistic market. But you know what? People still follow the Dow. And what I see here is something is odd. We have real market movement. You know, Francine, in sterling. You know, in the dollar, stronger. Some fixed income dynamics as well. And the equity markets are shockingly on bid. The long-term chart from the pandemic showing correction in yellow, bear market in red. Yes, we had a bear market off the pandemic horror back in February of a year ago. And then really it's been remarkably quiescent and with a movement upward. And the drawdown here in the equity market is remarkably small, Francine, on a Wednesday morning versus what we see in other markets, particularly dollar dynamics.
Tom, we're going to get a lot of economic data out in the next 28 hours or so between jobless claims, GDP, PCE. What catches your eye the most?
What catches my eye, without question, is what is 12 months forward growth on China. John Farrell's been on top of this. He's correct. It's all that matters. El-Erian and others would say 6% is the bogey for China. They've got to keep a 6% level to keep their employment model going, and they're not there. Goldman Sachs marks them down to, I believe, a 12-month forward 4.8%. And that's not good enough, and that rebounds right over onto U.S. data.
I mean, do we just give up of dreams of synchronized global growth now, Tom?
That's a really nuanced question, and the answer is I don't know if we were ever synchronized to begin with. The synchronization came from the marginal impulse of China. Project Syndicate launches at quarter end today, a fabulous 6-7 voice review of China. Rajan Rajan, Kenneth Rogoff, Stephen Roach, and others. And it's really, really an important set of documents just about that. And the answer is the synchronization came about by the growth of the marginal growth impulse of China. And the major question is that gone?
Right, but more than deceleration now, we just need to look at stabilization signs from China, Tom. And we hear it from the Chinese authorities actually asking financial institutions to make sure that property buyers are okay because of the cooling housing market.
I strongly agree with that. You know, you read your Elizabeth economy, you read the others, Francine, and they're going to tell you when in doubt, they always, in every case, stabilize. And I have to admit, I'm in the camp. You could phrase it any way you want, Francine. Beijing to the rescue.
It certainly looks like that, but we have to also look at how far they're willing to go and how far they're willing to pay. Tom Keene, a pleasure as always, co-anchor of Bloomberg Surveillance. Now, this is what else we're watching today. Kaylee, you're in politics in the U.S.
Yep, watching Capitol Hill, it looks like we have a budget deal will avert a government shutdown, but the infrastructure package is the massive question. Nancy Pelosi will bring that $550 billion bipartisan package to a vote. Will progressives sail it through or will they tank it? That is really the question. Of course, the progressives want to see more progress on that $3.5 trillion socially oriented spending legislation first. So you could see a make or break day for President Biden's economic agenda today, Danny.
Well, I am looking at something that we all love, and it's travel. You have G7 ministers for health and for transportation meeting today. Sources telling Bloomberg UK is hosting it. They're the de facto G7 president this year. The question they're going to be trying to solve is how do you restart international travel? How do you make it more easier? How do you have transportation departments versus the highest levels like the White House making these types of decisions? So it's going to be that. It's going to be vaccine passports. I think we could get some very interesting changes coming out of this, Francine.
Yeah, what I'm watching is the UK. So I'm watching the end of furlough and trying to figure out exactly what the impact for workers will be. The other thing is, of course, this huge repricing of the markets. Now the market's expecting 3 Bank of England hikes next year as inflation risks mount in the UK. This, you couple it with the faster rebound than expected in terms of GDP in the UK. So there's quite a lot going on. It's probably one of the most interesting, but also volatile economies, certainly when it comes to traders changing on pound. More Bloomberg Surveillance up ahead. We'll hear from Michelle Meyer, head of U.S. economics at Bank of America Securities, amongst others. This is Bloomberg.